Hello everyone, welcome to Demand Supply Trading Practical Session number 30 for the year 2025. Myself Sujit Kakkar, and today is Sunday 10th of August 2025. And before we get started with the session, let's get done with the basic formalities. So make sure you people go through the disclosure which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with stuff related to demand supply trading methodology. So in case you have still not joined this channel, you can be a part of this channel to be updated with the schedule of these live sessions. Plus, like already said, we also keep sharing content related to demand and supply trading methodology on this channel very frequently. Now, there are a few different ways you can join this channel. The first one is you can scan the QR code which is on your screen. Second, you can also find the direct link in the description. So once you go to the description of this session, you'll be able to find the direct link. You can click on that link and you can be part of this Telegram channel. And the last one is that when you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So once you're on our website, all you need to do is just scroll down on any of the pages to the footer section. And in the footer section, you can see you have this option, join Telegram channel. Just click on the join now button and you can be part of this Telegram channel, right? So these are a few different ways how you can join the Telegram channel. Next, today's session is all about practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available as a 100% free course. Now, okay, so I got some alerts. We'll ignore the alerts for now. And what we'll do is, as we move forward with the session, if we get the alerts again, then we'll look into it. Just give me a minute. Let me reduce the volume. Perfect. So like I said, I just got some notifications. I'll just quickly show you, right? And then we'll get back. So you can see we just got some notifications for the alerts. In fact, if I go here, you can see I just got a notification on alert that on PEPE USDT, we have a drop-based drop structure. So we'll talk about what these alerts are as we move forward in the session. But for now, let me remove it. And you can see the alert is also visible here on the chart. So for now, we'll ignore it. And like I said, as we move forward, we'll talk about what these alerts are. So again, coming back to today's session is practical application of demand supply methodology. So like I was saying that our demand supply course used to be a paid course. Now it's available as a 100% free course. When you go through the course content, you basically learn the methodology theoretically, but we also need to see practical application to understand how to plan trades very mechanically and rule-based, and that is what we do in these practical sessions. So almost every other weekend, I do a practical session where we take some examples, and to those examples, we apply the complete methodology so that you people can understand how to implement the strategy, how to plan trades very mechanically and rule-based. Now, the best part about these sessions is that we are not looking into something which has already happened, because like I always say, a move which has already happened, it's very easy to justify that move by applying a number of indicators, a number of oscillators. The real challenge, or I'll say the real beauty, is when you have to do the analysis in advance, and that is what we do in these sessions. We always pre-plan the areas of demand and supply where we would like to be buyers and sellers, and eventually in the future when prices, they revisit those areas of demand and supply, that is the time those trades, they get triggered. So basically you see me doing the analysis in advance. And just because we are doing the analysis in advance does not mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever those trades, they get triggered in the future, we also review them. So what happens is, because you're seeing both the before at the time of analysis and the after at the time of review, so you get a better clarity and better understanding of the methodology, and you also know that things were pre-planned, and this is how these sessions can be as transparent as it could be, because we are not looking into something which has already happened. We are always pre-planning, and then eventually we see how these zones, they worked out for us. So this also helps you build up confidence in the methodology, because when you're seeing the methodology work in real life situations, definitely we start building confidence in that methodology, and that is how we get inclined towards learning that strategy. So yes, again, today's session is practical application, and to be very comfortable with these sessions, there are also some prerequisites, and if you complete these prerequisites, these sessions will be much more easier for you. So let's discuss what these prerequisites are. So the very first one is our Trading Essentials course. Now, the reason it says optional is because someone who already has a very good trading background, very good trading experience, if they wish to skip it, they can. But ideally, I would suggest everyone to go through the Trading Essentials course. Now, the question comes, how can I access the Trading Essentials course? It's very simple. Once you're on our website, under services, you'll be able to find courses. And under courses, you can see the very first one is Trading Essentials. Click on it. And here you can see the course is available in 2 languages, English and Hindi. So whatever language you're comfortable with, just click on that button and it will immediately give you access to the course content playlist. Again, you don't have to do any signups. You don't have to do any registrations. Just clicking on this button gives you immediate access to the course content. It is laid out for you in a very systematic way, right? So it's a playlist for you. So just go through all the lessons systematically, lesson 1, lesson 2, lesson 3. And once you have completed all the lessons, that basically covers your Trading Essentials course. Now, once you are done with your Trading Essentials course, the next prerequisite is your demand supply trading course. So yes, now that you know the basics, you need to learn demand supply methodology. Now, how do you learn demand supply methodology? Again, under services, you have the option for courses. And now you can see the second one is your demand supply trading course. Click on this. This is also available in both languages, English as well as in Hindi. So whatever language you're comfortable with, you can click on it. And just like Trading Essentials, you'll have immediate access to the course content in a form of a playlist. So go through all the lessons and that covers your demand supply trading methodology course. Now, once you are done with the course, which will be theoretically, because these lessons are your theoretical lessons, but we also need to see practical application to understand how to implement this methodology. That is where you can see also have the option for the practical sessions. So these sessions that I do every weekend, we also keep an archive of it. And currently the archive is almost close to 1 year and maybe 8-9 months. So you have close to 2 years of recordings available to you. And the more number of practical sessions you will see, the better you'll start having the understanding of the methodology. So here also you can see the practical sessions are also available in 2 languages, English and Hindi. So whatever language you're comfortable with, you can click on that, get immediate access to the recordings of the previous practical sessions. Plus, anyhow, every weekend I do these live sessions as well, where you can join in live. And at the end of the session, I also take your questions, queries. So if you even have some doubts, some questions, queries, you can always put it in the chat box. At the end of the session, I'll also help you with your questions and queries. All right, so that's your first 2 steps for the prerequisites. The next one is the rule book. Now, during the practical sessions, you will see that when I plan trades, I use 2 documents. One is the rule book and the other one is the flow chart. So how do you get access to these documents? Again, very simple. On our website under services, you have the option for downloads. Click on it. And you can see the first one is the rule book. Click on download. The second one is the flow chart. Simply click on download and you'll have the rule book. So that's your rule book. And that's your flow chart. Right now, how to use these documents during the practical session, you will see how we use them to plan trades very mechanically and rule based. Now, before we get started with today's example, we do have some examples which were getting carried forward from the previous session. So we'll do the review of them. And after reviewing those examples, then we'll start with our today's example. All right, so the first one we'll look into is your session number 25. So the last time when we looked into it, session number 25, it was an open trade for us. It will still remain the same. You can see prices have just been trading inside of the zone. The zone has not yet been breached, so it will still remain as an open trade for us. We'll carry it forward unless and until we have an exit on it. So no modifications to this one, which is your session number 25. Now give me a second. Let's move on to session number 20, which was also getting carried forward. Just give me a minute. All right, so this is from session number 20. So the last time when we looked into it, we I think just entered the zone, but you can see during this week we have already reached 1:1. So what do we do at 1:1? At 1:1, we make it as a break-even trade. So now your stop loss, which was initially here, can be shifted to your break-even point. Now, when it comes to break-even, completely depends upon your trade plan. If you want to keep it break-even exactly at where you entered, which means that if it gets stopped out, commissions are from your pocket, right? But otherwise, if it starts going down, it doesn't hit your stop loss. But if you want that, you also want to cover your commissions, you can also have your stop loss a little higher, so that if it hits, it's an absolutely free trade, right? Even the commissions, they get taken care of. So that's completely your choice, how you want to make it as a break-even trade. Do you want to make it break-even including commissions or excluding commissions? That's completely your choice. But yes, as of now, you have the opportunity to make it as a break-even trade. So this will also remain as an open trade for us, but now it will be getting carried forward as a break-even trade. So the worst case scenario will be that if the prices they come back, it's a free trade for us. But if it continues, we'll trail onto it unless and until it gives us the target. So that's from your session number 20, and we have another one which we need to review. Let me open that for you. All right, so this is from session number 22, which was also getting carried forward. So here also you can see that during the week we have already moved up above 1:1. In fact, we were very close to 2:1, but as of now, again, we only have the opportunity to make it as a break-even trade. So here also the worst case scenario will be, again, now, the best thing is you can see that when we did the analysis, the charts were something like this, right? So you can always go back and you can watch the recording of session number 22 as an example, and you will see that when we did the analysis, the chart was something like this. And you can see then the prices came into our zone. That is where they reversed. And will it happen with every trade? Absolutely not. But this is the beauty of demand supply methodology, that if you are able to identify the areas where you're expecting prices to turn, then your risk is the smallest and your reward can be the highest, right? And that is the key criteria of a profitable strategy, that your losses should always be small, your winners should always be big, and that's the only way to be profitable. And if you can achieve this, you can be wrong, let's say 50% of the time, 60% of the times, you can still be a net profitable trader. Right, so again, we will carry forward these examples because we haven't got exit on any of these. They will still remain as an open trade for us, but yes, two of them now has been modified to trailing stop loss, which is at break even now. All right, so now that we are done with the reviews, let's get started with today's example. Now, today's example, I have picked it specifically to look into some of the concepts which will make it very clear to understand what do we call as a coinciding level, what we don't call as a coinciding level. So it's a very beautiful example with a beautiful contrast between different zones to understand the concept clearly. And in fact, if you look at this was also an example which was from session number 9. So the session number 9 for 2025 is where we did the analysis for it. You can see we have already got a really nice move from it. You can see this move is probably just give me a second. Right, so this move is probably your so this is your 4:1, 5:1, 6:1, 7:1, maybe an 8:1, 9:1 move. So we have already got, again, you can see the beauty. Can you see prices? They just touched the zone. That is where they reversed, which was from our session number 9. And this is what I was talking about just a few minutes ago, that the beauty is if you can identify these areas from where we are anticipating prices to turn, then your risk can be the lowest, your reward can be the highest, and that is again the key criteria for any profitable strategy, that your risk should be small, your rewards should be big. And the reason I'm saying that is because one thing which I can assure you is that there is no such strategy in the world where every trade is going to be a profitable trade. So this is something you have to accept from day one, that you will have stopped out trades. Now, if you will have stopped out trades, what is the only thing we can do? Now, if you talk about what can be the results of any trade we are taking, there can be 5 results, right? The first result can be that it can be a trade where you have a profit, or it can be a trade where you have loss, right? But like I said, there can be 5 different results, and those 5 different results are: it can be a trade where you have profit, which is a big profit. It can be a trade where you have a profit but a small profit. It can be a break-even trade. It can be a trade where you have a loss, which is a small loss, or it can be a trade where you have a loss, which is a big loss. Now, like I already said, one thing which is for sure, that there is no such strategy where every trade is going to be a profitable. So we definitely understand we'll be having trades which will go against us, and they will be our losing trades. So the only thing we can do now out of these five different outcomes is avoid this. So as long as you're able to avoid this, net you can be a profitable trader, right? Because your losses are always small. Your winners can be big, your winners can be small. It can be break-even trades, but your losses are never big. And as long as you take care of it, yes, you can be a net profitable trader. And that is what demand supply basically helps us with, avoiding these bigger loss, and also ensuring that we can participate in trades where our rewards can also be really nice and big rewards. All right, so let's get started with today's analysis. Let's go back to our flowchart, because if you want to plan trades, we should always be doing it in a very mechanical and rule-based way. Now, why we should be mechanical and rule-based when we plan our trades, I have explained this in a video. The title of that video is How to Start Trading. In case you're still not watched that video, the link is available in the description. Make sure you watch that video, understand the process I've explained, follow that process. You might have to go through that process twice, thrice, maybe even 4 times. But once you have done that process multiple number of times, you will see that by default, you will start becoming more of a rule-based trader and less of an emotion-based trader, which is very important. All right, so since we need to be rule-based trader, what we need to do is we need to create a trade plan for us. Now, when you start learning trading or you're learning a new methodology, it's not very easy to create a trade plan from day one, because to create a trade plan, first you need to have a good understanding and experience of that methodology. And to overcome this challenge, what I've done is I have created these 2 documents for you, the flowchart and the rulebook, which helps you plan trades very mechanically and rule-based. Now, the rulebook that I've shared with you is a conservative approach. With time, with experience, if you want to make some modifications to it to make it better suit your personality style, those modifications can definitely be done. But at least you do have a starting point using which you can start planning your trades very mechanically and rule-based. So what is our step number 1? Whenever you start planning your trade, the very first step is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why do we start with the trade purpose as our step number 1? And the answer to that question is that when we plan our trades, we use charts which are time-based charts, and we have n number of time frames available to us, right? So the very first challenge we face is that there are so many time frames available. So are these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want the duration of the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But understand that when you're trading markets which are not 24-hour markets, now just as an example, let's say if you talk about the NSE India market, which is not 24 hours, I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding a position overnight, we are taking that overnight gap risk, which cannot be avoided, right? So there is no way you can avoid that. So when you're starting as a fresher, my recommendation to all of you would be not to take this unnecessary overnight gap risk by keeping these positions overnight. So your hourlies and dailies should be strictly done as intraday trade, which means before the market closes, irrespective whether you're in profit, loss, break even, close that position, do not carry it overnight. Now for weekly, monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, we cannot have gap against us. It can still happen. But since we are leaning against some bigger time frames, the probability of having a gap against us definitely reduces, right? But it can still happen. But with time, with experience, if you want to include daily incomes into overnight trades, that can definitely be done. So my step one is I need to define my trade purpose, and let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind that this table, which is on page number 31, is for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, let's say cryptocurrencies, then you can look into the table which is on page number 32. Now I'll again quickly show you, we again got an alert, so we'll talk about these alerts as we move forward. Let me remove these alerts as of now. Let's keep it blank. Perfect. So since I will be taking example from the NSE, and I opted I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then the refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So yes, as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I again talk about NSE as an example, on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what we need to do now is we need to have a process in place which can help me get a smaller list out of these n number of symbols, because if I have a small list, I can do my analysis almost every other day. But if I have to go through 2000 plus companies every day, not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that computer program identifies that which symbols or scripts match with those conditions, and whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very important thing which you need to remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols. Scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list, which you need to analyze manually and check if they are in sync with your trade plan. If they are in sync with your trade plan, there might be opportunities for you. If they don't qualify based on your trade plan, then they are not qualified opportunities for you. Now, again, the challenge here is that all these scanner screeners, if you do a Google search, which, all those free scanner screeners you'll be able to find, they are all based on either conventional technical analysis or fundamental analysis. So there were no scanners which were based on demand supply trading methodology. So that is where we also have two custom built tools. One is called as the alert service. The other one is called as the demand supply zone screener. Now, during the session, I showed you that we got some alerts. So I'll just quickly tell you what these two are. But if you want to have more in-depth understanding of it, you can definitely click on it, visit the product pages, which is where the walkthrough videos are available. You can watch the walkthrough videos to understand them better. I'll also tell you how you can do it on our website. So once you reach our website, you can see under services, you have demand supply indicators. Click on it. And you can see you have your alerts and screeners. You can click on subscribe now here. It will take you to the product page where the walkthrough videos are available, right? So you can click on them to watch the walkthrough videos and understand them better. But I'll quickly tell you how they basically work. So if you talk about alerts, you can see what alerts basically do is, so currently what I've done is, you can see that in the alerts, I've given a list of symbols, and currently I have applied alerts to the 5 minutes chart. So what the alerts is basically doing now, that during the live market, as and when demand and supply zones are getting formed, it is notifying me, and that those were the alerts which you were seeing we were getting some time ago, right? So as and when the zones are getting formed, we keep getting these notifications. You can see the last alert was generated at 5:50. Currently we are at 5:54, so I'm on a 5 minutes chart. So in about 5 seconds, a new candle will form, and it will look for formation of new demand and supply areas. If we'll have new demand supply areas, it will give us the list, and we'll also get a notification. So if you get the alerts during the session, I'll now show you examples so that you can understand what alerts are. Again, quickly in a nutshell, as and when during the live market. Now currently only the crypto market is live, so that is why I have placed the alerts on cryptos. So if we'll have formation of any demand and supply areas, we'll get those notifications, and once we get those notifications, I'll show you how alerts they basically work. So that's your alerts. They keep notifying you on the formation of demand and supply areas. The next one is our screener, right? So here you can see the next one is the screener. So what screener basically does is that if I enable screener for a minute, and let's go to the daily time frame as an example. So now what you can see is that in the screener, I have given a list of, again, few symbols, and what I've done is I've given my proximity setting as 2%. So what I'm telling the screener is, okay, these are the symbols which I want you to track, and tell me out of these symbols in which symbol the current candle is within 2%, right? Can you see? Because my proximity is 2. So within 2% to a demand area or a supply area. So here you can see I've given a list of 15 symbols. So if I was doing it manually, I had to go through all the 15 symbols manually. But now I know that out of these 15 symbols, only Tata Steel is closer to supply, right? And if I'm doing my homework, I'm doing my analysis, I don't have to look at other 14 because they are not closer to demand or supply areas, and that is how time saving it can be. So if I just go to Tata Steel as an example, Tata Steel, you will see that we'll have a supply area, and you can see the current candle is pretty close to it. And what this is telling us is that the current candle is outside of the zone. You can see this is where my zone is, and we are outside of that zone. And from the closing price, if we move up about 1.96%, we will reach the supply. You can see if I check from here to the closing, to the supply, you can see 1.96. So from here, if we move up 1.96%, I will be into the supply area. So that is what screener does, that from your list, it tells you that on which symbols you are within that proximity range to a demand area or a supply area. And it can be used on any time frame. Like you can see currently I'm on the daily, so I'm getting the results based on daily. If I move on to, if I change this to weekly, now it will give me the results based on weekly. So you can see on weekly HCL Tech, we will be closer to a demand area. So if I change this to weekly and go to HCL Tech, HCL TEC, you can see we have a demand area. We are pretty close to it. And again, the same thing, that if we move down around 4.14%, we will be entering into that demand area, which you can see here, 4.14%. And similarly, if I go to a 5 minutes chart, I will also get the results based on the 5 minutes chart. So here you will see that I'll get result based on 5 minutes, but based on a 5 minutes chart, that 2% is a pretty big move. right? So that is the reason we might get a very big list. But as an example, if I'm trading a very small time frame, let's say a 5 minutes time frame, I might want to see where I'm probably within 0.5%. So if I change it to 0.5%, you will see the results will change, and now it will only show me symbols where we are almost 0.5% close to the demand area or the supply area. So let's give it a few seconds to refresh. I think I didn't change it to 0.5%. It's still 2, right? So 0.5, and let's click on OK. And now it is refreshing, and now you will see the list will be definitely a smaller list, because now I only need symbols where I am almost close to 0.5%. So can you see now we have a smaller list? So just as an example, if I go to Axis Bank, you will see on Axis Bank, I will be close to a demand area. Here you can see we have a demand area which is fresh, and if I look from the current closing price, we will be within about 0.5% to it, right? So you can see we are about 0.49, right? 48%. So that is what it is telling us. Exactly, it is 0.47. So that's what the screener does. So now you know how the screener and the alerts they work. So screener, it helps you identify symbols where you are within a proximity range to a demand zone or a supply zone, and alerts, they notify you during the live market as and when these demand and supply areas are getting formed. So again, now if I get an alert during the session, it will be much more easier for you to understand what alerts are. So if you get some alerts, I'll show you those alerts the next time we get the notification. All right, so that's your step number 2, which is to get a smaller list. And I showed you 2 different ways in which you can do it using demand supply zones. Yes, if you do a Google search, you'll be able to find a number of free scanner screeners which are based on conventional technical analysis or fundamental analysis. So it's your choice. Process can also be as simplified as that because I need a smaller list, I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list, but yes, a number of tools are available. Now, once you have your list, what you need to do now is, like I said, you need to analyze them one by one and see which one is in sync with your trade plan. And the one that matches with your trade plan can be an opportunity for you, and the ones that do not match with your trade plan, you simply skip them. So let's assume that the very first symbol we got on that list was ABC. So what we need to do now is, on ABC, we need to go to the lower time frame to identify a zone, and by zone we mean any of these 4 structures. And again, the best part is that our demand supply zone indicator, we provide a free 7 days trial for it. So if you've still not taken the trial of our demand supply zone indicator, you can do that. So how can you do it? Once you visit our website, under services, you'll be able to find TradingView indicators. Click on it, and you can see the very first one is demand supply zone indicator. So once you go to that indicator page, you will be able to find this button which says 7 days free trial. Click on it, and you'll get this form. In fact, I think the direct link should also be in the description. Now, it's a very small form, probably will take you less than 30 seconds. All you need to do is just input your full name, your email address, and your TradingView username. Now, very, very important, when you're providing your TradingView username, make sure that you are providing your correct TradingView username, because if it is incorrect, it will not get activated for you. It will get activated for whoever that TradingView username belongs to. So in case you don't have a TradingView account, you can click here, create a new TradingView account, then input your TradingView username here. And in case you already have a TradingView account, you can click here, visit your TradingView profile, identify your correct TradingView username, input it. You will get to know that on which date your trial will expire, and then you can choose the relevant option, that how did you get to know about us. And the last one is click on I'm not a robot, and click on finish and start the free trial. And once you fill this form, within 24 hours it will get activated for you, right? So again, everyone now has that opportunity. You can try this indicator for free for 7 days, and that is why when we do our analysis, we'll also do it based on this indicator to make the process very mechanical and rule based. So what am I supposed to do now is, I need to go to the lower time frame and identify zone. And by zone we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So let's go to the lower time frame, and here you can see this, the indicator is already applied. And since the indicator is already applied, You can see it is identifying demand supply areas for us. So it is telling us this is where we have a drop based rally structure. Now, what you can also do is you can see that in the indicator, we have an option that if you want the zones which are based on gaps, it can also identify those zones for you, because I can already see here we have a gap zone. So can you see if I enable gap patterns, we have this drop based rally. Plus, you can also see that once I enabled it, we also have a drop based rally here. You can see we are having these two gaps, right? One above, which is right here, and one below, which is right here. If I disable gaps, then it is not showing those gap zones. So let's get started with this one. So yes, I do have a zone. So if I have gaps disabled, let's look at this, but we'll also talk about those gap zones as we move forward. So yes, we do have a zone. So my step number 3, which was to identify a zone, is now automatically done by the indicator. It has already identified a zone for us. Do we have a zone available? The answer is yes, we do have a zone available. Now, once we have identified a zone, does not mean we'll blindly trade it. And that's the biggest mistake demand supply traders, they do initially. They find any demand area, randomly they try to buy. They find any supply area, randomly they try to sell, which is incorrect. Once you have identified a demand or a supply zone, the next step is to qualify it, which is a 2-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the first thing we'll check is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is the reason if a shift is required, we'll always make that shift before we proceed ahead. So how do we verify whether a zone is a case of level on top of level or not? Very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if we don't have a coinciding level, it cannot be a case of level on top of level. So let's get started with the zone we have already identified. Let's move back. So is this zone a zone which is coinciding with the intermediate? So if I go to the intermediate time frame, you can see here we do have this drop based rally structure. So this is my weekly zone. And what I'll do is I'll change the color of the weekly zone so that we can differentiate between the two. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes. We do have a coinciding level. So since we have a coinciding level, we also need to check, do we have only one zone or do we have multiple zones? So if I enable all demand supply structures and I also enable gap zones, you will see it is identifying now quite a few areas for us. So what you can see now is that this is my intermediate time frame zone, inside of which we have this as the very first zone, which is because of a gap. This is the second zone which we were already looking at, and this is the third zone, which is again because of a gap. So the concept we were talking about, that if you have an intermediate time frame zone and the same zone divides into multiple zones. Now for now, I'll say we are dividing into 3 zones, but as we move forward, you will see we are not dividing into 3 zones. We are only dividing into 2 zones, right? So that is the reason I was saying that's a very beautiful concept to understand what do we call as a coinciding level, right? So currently I've marked all 3, but now let's understand why am I saying that it is not dividing into 3 zones, it is only dividing into 2. So for that, let me draw this zone. This is demand, and let me also draw this zone, right? So I'm just drawing all these zones. So if I go back to intermediate time frame, so if you remember what I talked about, I said when your intermediate time frame zone divides into multiple zones. So on this chart, where is my intermediate time frame zone? This is my intermediate time frame zone, right? A zone means a leg in, your basing, and your leg out, right? A zone is always made up of 3 components. So if you look at these 3 components, which is my leg in, my basing, and my leg out, can you see this zone is getting divided into 1 and 2. Now this particular zone is not part of this intermediate time frame zone, right? This particular zone is basically maybe a test of the zone. We came into the zone, prices, they reacted, we started moving up. But this is where you need to have clarity that what is a coinciding level, what is not a coinciding level. So this is not a coinciding level, but these two are coinciding because these two are part of my intermediate time frame zone. So because now we understand that these two are the part of the intermediate time frame zone, what I should be doing now, first thing, this is a standalone drop based rally, which is also something we can call as a pro gap. This is also a fresh zone. Now, as a, let's say, not a very conservative trader, if you want to trade it as a standalone zone, yes, you can definitely do that. But when I see that I have an intermediate time frame zone, and probably this was test of the intermediate time frame zone, I would like to be a little extra cautious. And I have talked about this many times that I am a little on the conservative side. So whenever I plan my trades, I like to be as conservative as possible. And in that scenario, I can see that we have these two zones, which is a case of level on top of level. And if I go for the lower zone, my stop loss will also be below the distal line of the intermediate time frame, which would be even a better location to place your stop loss versus having your stop loss here. Because if you, let's say, have your stop loss here, prices, they go a little deeper into the weekly zone, we get stopped out, and then it might start going in my favor. But you never know, right? Prices can even react from here and I might never get an opportunity. So at the end of the day, it is your personal preference how conservatively or aggressively you want to plan your trades. I am a very conservative trader, so even though I know that I have a standalone zone, but because I know the zone was formed as a test of this weekly zone and prices can go a little deep into this weekly before we get a reaction, I would like to use the safest area out of these three, and this is the most conservative zone that is available to me. So yes, starting from this one being a case of level on top of level, I would definitely like to shift to this lower zone, and that is what I will be doing in this case. I will not be using this one, but again, I'll not say this is not a qualified area. This can be a qualified area if you do your analysis, but me being a conservative trader, I would like to go with this lower zone, right, which is a drop base and a gap up. So this is again a zone because of a gap. So let's move forward. In fact, let me do this now. Disable gap and all structures. So now, yes, we have identified a zone. The zone is also because of a gap. So my step number, sorry, not step number, my first qualification step, which is your level on top of level. Yes, it was a case of level on top of level. Whatever modifications were required, I made those modifications. Now, is this zone because of a gap? The answer is yes. Now, whenever you have a zone because of a gap, we need to apply the gap rules. So let's see what are the gap rules. In fact, just give me a second. Let me increase the volume so that in case we get some alerts, I'll get notified. Let me just check. Did we get an alert? No, not as of now. Perfect. So what are the rules for the gaps? So if I go to gap, you can see the rules for the gap is that whenever you're using gap as a demand or a supply zone, first it has to be an overnight gap, which we already saw. We are on the daily time frame. It's an overnight gap. It also has to be a pro gap, right? And this is definitely a pro gap. You can see the prices have been moving down, after which we got a gap up, which by definition makes it as a pro gap. And it also has to be an open gap. This is also an open gap. So all the rules for the gap, right, that it has to be overnight and open gap applicable. It has to be a pro gap applicable. This is not a symbol which is making all-time highs or all-time lows. So this condition will not be applicable, but whatever was applicable, we are qualified based on those conditions. So we have applied the gap conditions. The zone is definitely qualified for us. Pivot non-authenticity not applicable. Why? Because if you have a pro gap, you can ignore the rules of pivot and non-authenticity. So I'll just show you in the rule book that we have some additional rules almost, I think, at the end. Here it says, can you see in case of pro gap, you can skip the rules of pivot and non-authenticity, since being a pro gap, we already have that extra probability we are looking for. So yes, pivot non-authenticity not applicable, unstable equilibrium not applicable. So after looking at all the applicable rules, whatever rules were applicable, none of the rule disqualified the setup for us. So is it a qualified zone? The answer is yes. So now that we have a qualified zone, we'll move on to the next step, which is applying the boosters. So let's get started with the boosters. The first one is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have a gap, which is a score of 2. Time at the zone, we only have one candle in the basing, which is again a score of 2. Reward to risk ratio, will take it as an assumption, though it can change based on the arrival. But at the time of analysis, we'll always assume that we will have reward to risk ratio, because anyhow, if the RR is missing, we'll not be participating in that trade. Now, talking about the location, you can see that this zone is also located. Now, if you look into this, can you see we do have this demand area, but my proximal line is a little outside of it. So since the proximal line is a little outside of it, we cannot call it as very low of the curve. Now, the second thing will be, I have demand, I don't have supply. So how do I do my curve analysis? We have talked about these scenarios a number of times. So what we discussed was that if we have demand, you don't have supply. So the latest pivot high, because if the prices they move down from here, it can be only one reason, and that one reason is there has to be supply. It's just that supply is not visible on this particular time frame. It might be visible on a smaller time frame. So using it as a reference point, I can draw my curve, and now you can see we are planning our trade low on the curve, right? So we are low on the curve. Low on the curve gets a score of 1. Talking about the trend, if I go to the weekly time frame, you can see we have one supply violation, we have one demand violation. So we are in a sideways trend, and sideways will be a score of 0.5. Just give me a second. Right, so sideways will be a score of 0.5. Move from the zone, we need at least 4:1 move, and that has already happened. So if I again draw my, you can see 1:1, 2:1, 3:1, 4:1. So probably we have a 6:1 move. So we already have our 2:1 move, which is already done, gets a score of 2. Sorry, not 2:1, 4:1 move, right? So it gets a score of 2. It is definitely a case of level on top of level. We have already verified that. It is also coinciding level. The last one is trap, which in a way becomes irrelevant. Why? Because whether it is 0 or 1 doesn't make any difference. It will still remain as a type 1 trade for us. But let's verify. So if I take a horizontal line wherever the proximal is, and if we start pushing it up, you can see that probably this area. Can you see this area has beautifully worked like resistance in the past, right? Worked like support, working like resistance, working like resistance, again working like support. So we have a pretty clean area of support and resistance. So what will happen is people who believe in support and resistance at support, they will buy, and their stop losses will be placed below this area, which will be sell orders, right? Which are the stop losses. And in case we get a breakout, then people who believe in breakout trading, they will also start selling. So by the time we get into this area of demand, we know we'll have a lot of selling coming into the market because of the stop losses, because of the breakout traders. And what are these people doing now? They are making two novice mistakes. Mistake number 1, they are selling after a decline in price, which means they are selling at a cheaper price, and also in an area where the prices have proven to us that back in history, demand exceeded supply. So that possibility is there that this zone might work like an area of trap, for which we'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, which makes it as a high quality zone, and 6.5 out of 8, which also makes it as a high probability setup. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know this is a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Whenever the prices are back, we'll have to re-verify, because markets are not static, markets are dynamic. conditions are changing almost every other second. So before entering the trade, we need to verify, does it still qualify based on our trade plan? If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade, like you saw in some of the examples we were reviewing today. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And if these sessions are helping you with planning your trades more efficiently, planning better trades, then do like the video. If you're not subscribed to my channel, then do subscribe, so that whenever I do these sessions, you get you're notified for it. And yes, if you have any friends, family members who are into trading, then do share the link to my course content, to these videos, to the trial of the indicator, because all these content is available absolutely 100% free. So the more number of people you can reach, more people can take advantage of it. And I'm pretty sure you also understand a lot of people are struggling with trading. So the more you help the community, the better it is for all of us. So do share. And yes, like I said, at the end of the sessions, I look into questions, queries that I get from you people. But before I do that, let me also add that one feedback which I was getting from you people is that what if I don't want to ask my questions publicly, or in the chat box I cannot share my analysis? What if I want to share my analysis? So now we do have an option for one-to-one session. So once you visit our website, on the top right corner, you'll find one-to-one, where you can schedule an appointment with me. There are two options available: voice call and an online meeting. So if you feel that on a voice call you can ask your questions, queries, and that will resolve your issues, you can go for a voice call. If you feel that you want to share your screen, you want to share your analysis, then you can also go for an online meeting. But otherwise, if you're comfortable asking your questions, queries during the live session, you can definitely do that during the live session itself. So now let me look into the questions, queries quickly, because I need to take the Hindi session in just about 10 minutes. So gaps are a little confusing. So see, it's not just about gaps. Everything that you start learning initially is confusing, right? So it's just a matter of practice. The more number of examples you will see, the more you practice, things will start getting easier on you. And the best part is, even if it is about gaps, the indicator automatically identifies for us. All you need to do is understand whether it is a pro gap or a novice gap, which is a very simple definition. You just have to see the dominant price direction before the gap happened. And if that dominant direction shows you that the prices were moving down and we got a gap up, which probably means that after the prices they got cheap, somebody was trying to buy a little expensive for a bigger fill, that's a pro gap. Similarly, if the prices were moving down and we moving up and we gapped down, could be a pro gap. So that is all you need to do. But like I said, it's not just about gaps. Anything that we learn initially is a little confusing, but the more examples you will see, the more practically you will apply it, the easier it will start getting on you, right? So again, the best part is these sessions are also recorded, so you can watch the session over and over again, multiple number of times. That can also help in building up a little bit clarity. All right, so that brings us to the end of today's session. Thank you everyone for joining in. I'll be seeing you the next weekend. Till then, trade safe, enjoy your Sunday, take care, bye bye.